Krishna from Evercore ISI's vice chairman, and also Wall Street Journal's chief economics commentator Greg Ip is with us. They both join us right here on the CNBC Newsline. Good morning to you. You just heard a little bit of the debate that we've been having. Krishna, do you look at this stimulus plan and think it's enough?
Look, I think it's very clear that we've gone past the point where the Fed, and for that matter, other central banks, can carry this on their own. So a government has to step up. This kind of $1 trillion, roughly, aggregate package feels like it's in the ballpark. If you want to be efficient here, you need to have multiple different elements in it. There needs to be some credit guarantees. There needs to be income support for people who are losing their jobs. There needs to be funding for credit to businesses that were doing just fine prior to the crisis. So I think what we see here is, appropriately, at this phase, a lot of the costs now move from private to public balance sheets. Of course, that's weighing heavily on the Treasury market today.
Hey, Greg, you've seen this plan. You heard that Treasury Secretary Mnuchin suggesting we could have 20% unemployment in this country, which would be remarkable and remarkably sad. Do you think that's right?
Look, we're dealing with an unprecedented shock. I simply don't know what kind of precedent to look at to understand the parameters around here. You've got, it's like a heart attack, and each minute that a heart attack goes on, more of the muscle dies, and I think that's the kind of risk that Secretary Mnuchin and others are talking about here. We saw figures yesterday from the travel industry. This is just one industry. They said they're looking at a third decline in their business, and that would push the unemployment rate up from 3.5% now to over 6%, a doubling in unemployment from one industry alone. Of course, again, the uncertainty here is just tremendous, and it has a lot to do with how bad does the epidemic get, and how long do these shutdowns and social distancing measures get. And in that kind of environment, I mean, I don't think if you're the fiscal authority, like the Secretary of the Treasury or the Fed, there's any benefit to underestimating how much you ought to do. So you may as well start with one of the bleaker prognoses and go from there.
Krishna, you were sounding the alarm on dysfunction in the Treasury market earlier this week. How do you think about the markets themselves and their ability to function throughout this? There has also been talk about whether we should shut the markets down.
So although the stock market has been incredibly volatile, the equity market has performed well. The really alarming thing over the past week or so was the freeze-up in fixed income and credit markets, which extended to the absolute core of the system, the Treasury market and the MBS market, as well as corporate credit and many other business funding markets. Now, the Fed has moved aggressively to tackle this problem at the core of the system with this massive surge QE trying to reliquefy the Treasury and MBS market. I think the initial package they delivered Sunday, while very impressive in many regards, was light in terms of its support for business funding and business credit. The liquidity side, the credit support side, needed to be built out further. So the good news is that the Fed, a little late, but nonetheless, the Fed delivered the CPFF commercial paper backstop yesterday, and then the PDCF, which allows the dealers to fund a very broad range of collateral. So the Fed is ramping up to fill out, to complete, to more complete the support that they've provided. Many markets are still functioning very poorly, but what we will be able to do, I think, hopefully, if we get some risk capital out of this fiscal stimulus package, we can then look to a more aggressive new generation of Fed 13.3 programs paired up with risk capital and guarantees from Treasury to replicate some of the more ambitious programs.
Hey, Krishna, Joe's got a question for you. Hey, Krishna, Joe's got a question for you.
Yeah.
No, I want to ask Greg a question. Actually, I put one of Greg's books behind me, too. I don't know about it. Didn't make the cut in terms of the shot, but I got you in here, Greg. But yeah, let me ask you about the 20%. Is it possible that you look at that as a really transitory thing? Just maybe it lasts, I don't know what it is. And if I'm just wondering if we went into this with what people say was a pretty well-functioning economy with unemployment and growth and everything else, does what we're going through actually break that so that we can no longer count on the rebound in 3 months going back to where we were with that strong economy, or does that 20%, does that linger and really becomes depression-like soup lines and everything? I would think we could bounce back quickly, and once people left their houses, the service industry might bounce. Am I wrong?
Well, I think the historical precedent would be along exactly the scenario you're laying out there, Joe. I mean, when we have seen these kind of natural shocks to the economy, you do get like what I think Mohammed El-Erian calls a sudden stop. But after the shock passes, you do come back to life fairly rapidly. You know, in Louisiana, after Hurricane Katrina, the unemployment rate doubled to 11%, but within a few weeks it was back to normal. In Hong Kong, the economy shrank like 9% in the second quarter, but in the third quarter, just during the SARS epidemic in 2003, by the third quarter they made all of that back. But there's a couple of reasons you don't want to take those as templates right now. First of all, this is it's not just like, this is bigger obviously than all of Louisiana. It's bigger than all the United States. It's the entire world going into cardiac arrest at the same time. Secondly, the main factor which determines when you come out of it, we don't know that. Like, we know that an earthquake ends, we know a hurricane ends, we know like even Fukushima's meltdown ended, but we just don't know how long the epidemic will take to control or when the lockdown can be lifted. We have a few templates from China, from South Korea, from a few other countries that seem to have gotten past the worst of it. That gives me a little bit of hope that maybe this lasts a month or 2 months, in which case supplying the kind of liquid support that the Fed and the Treasury have been doing and the fiscal package will be doing are very, very encouraging. What I do worry about is that the longer this goes on is that these companies, which are what we would call illiquid, they don't have the cash to pay the bills today or next week, they become insolvent and they fail, and that when the lockups are lifted, a lot of these laid-off workers will not have jobs to go back to. I think that's the risk you want to worry about.
Hey, Greg, we were talking already about the politicians who want to make sure that they can exact some change on the industry, particularly on the top executives. Got any ideas about where you think the most punitive kind of changes might be coming? Airlines, or are you thinking Boeing?
You know, the risk here with TARP, what we saw, back in 2008 was that a lot of the stringency and the conditions imposed on TARP and other lending programs meant that banks were unwilling to access them, and they didn't do the good with the speed that they should have done. So I think Congress is going to have to sort of be careful about demanding absolutely everything they can in return in terms of things like CO pay and buybacks. Now, those ought not to be very big conditions to ask for, saying no buybacks in X period of time, no CEO pay increases, and so forth. They ought to be able to structure bailout mechanisms similar to what we've seen in the past to ensure that there's private loss sharing, to ensure that there's some upside to the taxpayer. You could attach, there's a lot of ideas floating out there. You could attach warrants to it. You could do this in the form of, say, convertible preferreds and so on. But Becky, no question, you're going to get a lot of pressure in this period. We're still dealing in some sense with the blowback and the bad memories of TARP and so forth. No question that as these bailout mechanisms are put together, you're going to have some sorts of mechanisms in there to guard against what the public will ultimately see as sort of self-serving behavior as on the part of corporates. And I think the smart corporates will know that, and they'll agree to that. I would just caution that as this mechanism is put together, you don't make it so punitive that nobody actually uses it, because then it doesn't do what is needed right now.